What is going on, guys? Nick here, back with another video. You guys asked me to take another look into Alibaba stock, so here we go. On February 24th, Alibaba reported its third quarter earnings. The shares dropped after reporting their slowest year-over-year revenue growth on record at only 10%. Alibaba's been facing a lot of difficulties over the past year that have caused the stock to sell off. They've recently dealt with slowing growth within China as e-commerce competition has increased. This all comes on top of the regulations imposed by the Chinese government related to antitrust and data protection, and as well as some extra attention or maybe punishment after Jack Ma, Alibaba's founder, previously spoke out against the Chinese government. Alibaba CFO Tony Xu said, "At the current price levels, we plan on continuing our share repurchases. At the same time, we will maintain a strong cash position that gives us the financial flexibility for future investments." They've used this drop in share price to buy back about 1.4 billion of its ADR listed shares and plan to continue until at least December of 2022. So let's take a look at what Alibaba reported and how the business is actually performing. So Alibaba reported earning $2.65 per share versus the $2.54 expected. Revenue came in at 38.06 billion versus 38.65 billion expected. So a slight beat on earnings but a slight miss on revenue. When we look at a full year of earnings reported by quarter with the most recent earnings in red, we can see that this is a pretty big drop from a year ago. Since September of 2019, Alibaba's profits actually haven't seen any growth, and recently they've seen a pretty big drop off. This chart showing the past 10 years worth of earnings and revenue shows what's caused the concerns about the company. While revenue has shown it continues to grow, the story is not the same for the profits that again saw no growth between 2020 and 2021, and then a big drop into 2022. Looking at Alibaba's revenue versus expenses, we can see that expenses have creeped up a little bit. The past 12 months have not seen as much operational profit margin as the past. So looking further into what costs are increasing, it seems like the two major drivers as a percentage of revenue are the cost of revenue, which has seen a slow gradual build up since 2019, and the sales and marketing expenses. Alibaba explains the cost of revenue increase is due to the growth of their online and brick and mortar chains. I think that things get really interesting when we take a look at their individual segments reported. Alibaba used to report three segments: commerce, cloud computing, and digital media. And we can see that commerce is the only real producer of revenue and profits for the company. When we zoom in on each of these charts, we can see that while both cloud and digital media are moving towards profitability, neither are profitable. I was actually pretty surprised to find out that the cloud business especially isn't profitable, because for many major cloud providers in the United States, cloud computing is extremely lucrative and usually has pretty high profit margins. Alibaba reported that the last quarter saw slower growth in the cloud business at only 20% growth, which is still a very high number. But the slowdown has come as TikTok has moved off of Alibaba's cloud. Apparently, some of the Chinese government crackdowns on gaming and education to major cloud business customers has also hurt some of demand. Looking over at their largest segment, the commerce platform, saw a slight drop in profits. Now, Alibaba's new reporting structure actually breaks this segment down even further. So looking at all the components of the commerce platform here, we can see how it's actually structured. Now, just to point out, this chart has some weird data on it. It's only showing the first to third quarter for 2020 and 2021. Unfortunately, this was all the data they report, so it's the best I could do. We see that Alibaba's commerce platforms aren't profitable outside of China. While the Chinese business saw continued revenue growth during 2021, profits dropped. Alibaba says this is due to rural expansion of the Chinese commerce business. But my concern is if the real core of the business and the driver of value for now, the commerce segment as a whole, is seeing revenue growth go from 30 to 40% to only about 20%, the high earnings multiple we've seen for Alibaba in the past just won't be justified in the future. This is why the massive drop in share price for Alibaba is far more justified and not as much of an overreaction as some have claimed. So looking at the forecasted earnings for Alibaba, we can see they're currently projected to go from 133 billion in revenue and 10.5 billion in profit to 178 billion in revenue and 28.3 billion in profit. Looking at the projected revenue growth, the current growth is projected to fall to 13 to 18% over the next few years. And when we look at net income growth, we can see that by 2024, the highest upside is to 14%. So using a growth rate to value Alibaba between 13 to 18%, that gives us a fair value between 28 to 44. Looking at this valuation charted out, Alibaba is very cheap, especially if the current growth forecasts are accurate. However, all of this depends on Alibaba matching the forward estimates, and I'm not sure how much I trust the estimates in this situation. Alibaba is facing a lot of headwinds. Pressure from the government to reduce the power of big Chinese tech companies, more e-commerce competition, and on top of this, the Common Prosperity initiatives. President Xi has said that under Common Prosperity, the fundamental requirement of socialism is to balance growth and financial stability. And this has resulted in the Chinese government calling for more reasonably adjusted excess incomes and encouraging high-income individuals and businesses to give back more to society. To me, it sounds like the Chinese government is saying that they aren't going to allow companies like Alibaba to grow and take massive profits in. And I think the mistake too many people make is viewing the Chinese government from a capitalist perspective, thinking that the government will only take some money for now, but things will get back on track. But I don't really agree with this perspective. I think that President Xi's vision seems to say that big business should support the heavily impoverished regions of China, especially those in rural Western China. He also doesn't want to see single businesses take in massive profits. And I don't think that they want to see Chinese big tech become politically powerful and a threat to the Communist Party. Now, there's a really good article written by the Brookings Institute that explains some of this, and I highly recommend you guys read it if you want to learn more about it. I'll include a link in the description. Now, if you want to see my previous video where I explain why I changed my mind about Alibaba in November, click right here, and as always, thanks for watching.